The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and welcome to Nova 401k Associates webinar on what does the 2020 election mean for retirement policy. Today's webinar is eligible for CFP, ASPA, and IRPA CE. In order to receive a certificate of attendance, you must be registered individually, remain on the webinar for the entire presentation, and complete the survey for CFP and IRPA CE because there is additional information needed to provide credit. The survey will pop up as soon as the webinar closes, so please be on the lookout if you are needing CE. In addition, we have also included the slides as a handout on your GoToWebinar panel, so feel free to download and follow along. If you have any questions, please type them in the questions box. We may get to a few of them throughout the presentation, but if we are not able to answer your question today, we will provide you with an answer individually via email. Also, if you know someone who wasn't able to attend or if you have to log off for any reason, this webinar will be recorded and posted to our Nova YouTube channel by the end of next week. Today's presentation will be presented by Craig Hoffman. Craig is an attorney/senior consultant with Nova in Houston, Texas. For over 35 years, Craig's practice has focused exclusively on federal tax and ERISA matters relating to design, implementation, and operation of tax-qualified retirement plans. So without further ado, please welcome Craig Hoffman.
Thank you, Jasmine. Hello, everybody. Good morning out west and good afternoon here in town. Yes, I am new to Nova, but I'm not new to the industry. I was at Relias, FIS for 24 years, 10 years as general counsel to the American Retirement Association, where I did a lot of lobbying and the like. So today's topic is a fun one for me. It is what does the election mean for retirement policy going forward? Obviously, elections have consequences, and this one certainly did. So we'll talk a little bit about the election, what it means for regulatory policy from a Biden administration, and then we'll talk about some legislative proposals that are sure to come before a new Congress. Now, let me begin by saying that, the Electoral College has not yet voted, but all indications are that Joe Biden's going to be our next president and Kamala Harris our next vice president. So we're going to work on that basis. I know the votes haven't been counted, but I think at this point it's pretty clear that's probably where we're going to end up. So with that said, that also we know what party will be controlling the White House. We know what party will be controlling the House of Representatives. The Democrats maintained their majority, but they lost some seats. And so it's looking like they will have a majority of somewhere between 12 and 15 seats, smaller than the 21. But still democratically controlled, and therefore the Democrats control the agenda there. In the Senate, we don't know. We do know that the Republicans control 50 seats at the moment, and the Democrats 48, and we have 2 open seats that are going into a runoff in Georgia. Obviously, if both of those seats go to the Democrats, then the Democrats will have control of the Senate by virtue of any 50-50 ties are broken by the president of the Senate, who is the vice president of the United States. So a lot is riding on what happens in Georgia as far as what agenda actually gets put forward in Congress next year. Either way, no matter what happens, it's going to be a divided Congress in both houses. But certainly, if the Republicans can get at least one of those seats, they'll be in a much stronger position to tamper back, if you will, some of the more progressive proposals that have been floated around out there. And so this is where we will be, assuming the Republicans get one of those seats. We are likely to see much of the same in Congress as we've seen the last couple of years with the divided House and Senate. And that is an interesting dynamic, obviously, for many reasons. It would stem some of the more progressive ideas, but it also, believe it or not, Congress does want to appear to be getting something done. And we'll talk about a little bit later, the newest pension reform bill, the Securing a Strong Retirement Act, has been dubbed Secure 2.0. It is very much like the bill that was passed last year that ultimately became Secure, that made, as many people know, a number of important changes in retirement policy. That was a bipartisan bill, and the bill being considered right now, Secure 2.0, is a bipartisan bill. And as even in the divided House last year, the bipartisan retirement reform bill, Secure, passed the House on a vote of 417 to 3. And I'm afraid, there is nothing more bipartisan than that. So a divided Congress still may mean a lot of change coming up potentially for retirement policy in the new Congress. Let's talk about the regulatory agenda and what we're expecting from the new administration. Assuming Vice President Biden is our next president, then on Inauguration Day, expect his chief of staff, literally coincident with the swearing-in ceremony, to send a memo to the heads of all federal agencies basically telling them to stop what they're doing until there is a Biden appointee in that federal agency to review any regulations that they are working on. So don't send any regulation to the Federal Register for publication. Withdraw any regulation that's been sent but not yet published. And if there are any regulations that have been published but have not taken effect, postpone them, its effective date for 60 days. And this was done by President Obama. It was done by President Bush. This is a tradition of all presidents. There's some question whether he can really extend its effective date by 60 days without going through a formal regulatory rulemaking process, but usually these extensions are of a short duration that they really haven't been challenged in court. So what regs are not subject to the freeze? And for those who have been watching, you have seen the Department of Labor, particularly in the last 6 months, 8 months, really push to get out regulations. The Secretary of Labor, Eugene Scalia, is an administrative law expert, is the son of the former Supreme Court Justice, and he's a very smart guy. And so the Trump administration, and this is not singular to them, other administrations have done the same things over the years. The Obama administration did it with the fiduciary reg. They try and get their last chance to affect policy, because once a piece of guidance is formalized in a regulation, the Administrative Procedures Act kicks in, and it becomes much more difficult to overturn a regulation. You've got to go through the whole formal rulemaking process and the like, and so that's why the rush was. Another reg that will be effective before the Inauguration Day is this recent reg that the DOL just got out on the use of so-called non-pecuniary factors in the selection of planned investments. This deals with the ESG investments. In the Bush administration, George W. Bush, there were a sub-regulatory guidance that indicated that you should not take into account ESG. The Obama administration reversed that. These regs basically say you can't consider anything other than what is in the best interest financially for the plan in selecting plan investments. That was finalized, or the final regs were published November 13th, and they're effective January 12th, which again is before Election Day. A class exemption dealing with investment advice in the fiduciary rule was published July 7th. It reinstates the old 5-part test. It also has a controversial provision subjecting rollover recommendations to a fiduciary standard. The final exemption was sent to OMB last week, I think on the 24th, and OMB should have it out shortly. It's likely to have a 30-day, it's got to have at least a 30-day delay before it becomes effective unless there is very good cause otherwise, but even that should be before Inauguration Day. This may end up being an issue for Congress to reconsider to change the rules with regard to investment advice. I'm afraid we're probably going to relive all of what we saw before. What else? Well, what regs now might be subject to a freeze? We've got proposed regs on benefit statements, a lifetime income illustration where you have to convert an account balance into a single life annuity. Those will take effect next year, and it's possible they could be frozen, but I'm not sure there was anything too controversial in them. The second bullet on this page, however, the final regs on proxy voting essentially follow the same policies as were enunciated in the non-pecuniary factors. It essentially says planned fiduciaries should not expend resources to vote proxies unless it's really going to affect the financial return to the plan. And it's got new procedures that you have to document. Those were sent to OMB for review November 25th and should be able to get finalized before Election Day. And the real question is whether there'll be a 30 or 60-day effective date delay, if you will determine whether it can be questioned by a freeze on regulations. Okay, so we know Biden, his administration is going to try and stop everything and may make some changes. In addition, what else is out there that needs to be regulated? And the DOL last summer put out a request for information on whether the providers of pooled employer plans needed a proposed class exemption so that they can sell proprietary products to the participants in the PEP. Richie Neal is the chairman of the House Ways and Means Committee, wrote a comment letter saying, hey, look, we wrote the SECURE law that gave us PEPs. We don't want conflicts. That's something that's going to fall in the laps of the Biden administration. Additionally, there is a whole slew of regulations that will have to be issued to implement the pooled employer plan rules. Try saying that 3 times fast. And so there's a lot that they will be addressing with regard to pooled employer plans that's going to now fall into a new DOL. Likewise, as I mentioned, the definition of an investment advice fiduciary is almost certainly to be revisited again. And then lastly, just quickly, because I'm afraid it's probably not, well, not afraid, but it appears it's not going to come into play, and that is the Congressional Review Act, which allows Congress to nullify via a resolution of disapproval a regulation within 60 days of it being sent to the Congress and finalized, if you will. And so the legislature has 60 legislative days after it receives that regulation to vote up or down. If both houses of Congress vote it down, and the president signs that nullification, like any other law, the president can veto it, or he can sign it. If he signs it, then the regulation is nullified. That only works when you've got a change in administration at the White House and both houses of Congress are part of that administration. The Trump administration was able to do that with the Bush administration was able to do that. So the other point to be made, the 60 legislative days, nobody knows how many legislative days remain in this Congress, but it's likely what happens is when the 60-day period is still outstanding, as Congress adjourns a session, the 116th session, the 60-day deadline resets when the new Congress, what will be the 117th Congress, is seated in January. And so recent regulations finalized since the middle of July potentially could be nullified, but that will depend on the Democrats taking both Senate seats in the runoffs in Georgia. Okay, so have some idea of some of the regulatory stuff we might be seeing, but what about some more big ticket items that President-elect Biden may be considering? I don't know why, but it didn't seem like there was a lot of retirement policy debate during the campaign. It usually is not a hot topic, to say the least. But nevertheless, Joe Biden has his so-called Plan for Older Americans, which is, you can find it, it's still on the campaign website. And it throws out, basically, there are two ideas that stand out. I mean, he has some discussion about reforming Social Security and other things on this webpage, but the two that are most of interest, I think, to those of us who work with retirement plans or sponsor retirement plans relate to changing the structure of how tax incentives are provided for retirement savings here in America. But first, the first of his policy initiatives is to mandate all employers adopt an automatic enrollment payroll deduction workplace savings arrangement. It's not clear if this would be an IRA or 401k or some combination thereof, but it would be an employer mandate. You must have a plan. There are some exemptions. If you have sponsored a qualified plan within 1 year of the, it's not that clear, but if you are already sponsoring a qualified plan, you would be grandfathered and would not have to adopt this payroll deduction plan. The payroll deduction plan would apply to any employer who's been in business for at least 2 years and has more than 10 employees. So very small employers would be accepted from this mandate. What the campaign web page does not go into great detail. What is likely that this could get what the Biden administration may end up backing is a proposal from Richie Neal, the chairman of the House Ways and Means Committee, called the Automatic 401k Act. And we're going to try and save a little time to talk about that near the end. So I think that would likely be the vehicle to implement this Biden policy proposal. The second one is pretty radical. over the years, the progressive voices in America have criticized our current system of tax incentives associated with saving and retirement plans as unfair to lower income workers and taxpayers. And this is because of the effect the marginal tax rate system operates in America. So that, for example, under current law, contributions to define contribution, and this is only a DC plan. He doesn't do anything with DBs or doesn't mention it. I'll come back to that. Under current law, if you've got a 401k plan and you contribute $10,000 to it, it's going to be excluded from your income. Similarly, if your employer puts in $10,000 as a profit sharing contribution, it's not included in your income. If you had been currently taxed on that contribution and you were a single taxpayer making $600,000 who's in the 37% marginal tax bracket, that a $10,000 contribution would save you $3,700 in taxes. And it's an important reason many people sponsor retirement plans. On the other hand, if you're a single taxpayer making $60,000 and you made that same $10,000 contribution, you would only save $2,200 in taxes because you're in a 22% marginal tax rate. And the progressive argument is, rich Americans, wealthy Americans, they're going to be able to save for their retirement one way or another. We need to focus the tax incentives on helping lower income Americans close the savings gap for their retirement. So what would he do? Well, basically, this is taken word for word from the webpage, and the highlighted sentence is the key. The Biden plan will equalize benefits across the income scale so that low and middle income workers will also get a tax break when they put away money for retirement. And what the centerpiece is, it would eliminate the deferral of income tax being recognized when a contribution is made to the plan. In other words, when you contribute to the plan, you're going to be taxed right up front on it. And it appears the contribution would then remain in the plan and could grow with earnings. The earnings would accrue tax-free, but then be taxed when they're ultimately distributed from the plan. So it would operate the same way for those of you who've ever had dealt with after-tax voluntary employee contributions. And so it would appear that this would be taxed the same way. And obviously then, if you make all contributions currently taxable, that's going to raise a boatload of income tax. And what the Biden proposal would do is use that money, the taxes that are raised by that change, to pay for a tax credit rather than having a deduction. And so you would get a credit equal to some percentage of the contributions you make or your employer makes. It's not entirely clear what the percentage would be, but the past literature has suggested a 26% credit would be equal to the revenues. To pay for a 26% credit would even out with the revenues gained by making it all taxable up front. And so the effect of this change, you can see on the screen, the individual was making $600,000 who gets a $10,000 contribution. He gets a $2,600 credit. The individual making $60,000 who made a $10,000 contribution, he too gets a $2,600 credit. And so the wealthy person ends up with $1,100 higher taxes, and the individual at $10,000 goes up to $400. Now, there are a lot of, I used a person in the $60,000 tax bracket to make a point. The progressive argument is there are many people who don't pay any income taxes and get no tax benefit by virtue of excluding a contribution from income. And so the progressives really are focused more on those people necessarily than the chap making $60,000. But needless to say, any way you slice it, this is going to result in a significant reduction in tax incentives for the owners, and it fails to acknowledge or recognize that the tax incentives for defined contribution plans are a bargain between the tax code and the owner. And what I'm trying to get to is we have policy implications already built in the tax code to make sure it's not unfair to rank and file. We've got the whole non-discrimination rules and that you can't favor highly compensated. We've got the 401k tests that look at the average deferral rates, if you will. We've got top-heavy rules that require non-key employees to get top-heavy minimum benefits. And so this is something that is going to be talked about. Whether it goes anywhere remains to be seen. Will it go anywhere in the next Congress if the Republicans control the Senate? Probably not. But keep in mind, presidential terms are 4 years, and there is, again, I'm a little early, I know, but we're already thinking about the midterm election in 2024. And in that election, there are 24 Republicans up defending their seats against 22 versus 12 Democrats. So the election calendar, if you will, favors the Democrats in the midterms, and this can still be hanging around. But it would have to be, I think, both houses of Congress have to be in a Democratic control to see this move forward. What will move forward potentially? The one who's getting all the attention is the so-called Securing a Strong Retirement Act of 2020. Now, few of you probably know, but that law in and of itself, if it becomes law, would violate another federal law, the Pronounceable Acronyms Act. SRA 20 is not something that rolls off the mouth. And so, and that's, I know, it was a joke. I'm trying, folks, not a lot of humor here. I thank Darren Watson. I stole that from him many, many years ago. In any case, this bill has come to be known as Secure 2.0, which is indicative it's the next round of pension reform, and it's got bipartisan support. It's co-sponsored by the chairman, Democratic chairman of the Ways and Means Committee, and the ranking Republican member of the Ways and Means Committee. And it is a pretty extensive bill. And did I tell you it's bipartisan? And that, as I alluded to earlier, could actually give it some legs. We'll come back to that a little later. It's got 5 titles, 36 sections. It is likely, I actually was talking to some of my colleagues at the American Retirement Association this morning, and as I thought, and they agreed as well, it's not likely this is going to be enacted in this Congress. There is always a chance in the lame duck, but it has not gone through the vetting process that typically a bill like this will go through, where you have a markup. That's where the senators all get in a conference room and make amendments to the bill and the like. The bill itself, as we go through it, costs an enormous amount of money. So, it's going to have to find the right train to hitch to or come up with some tax increases to pay for it. So I think this bill is more likely than not an exercise we'll see in the next Congress, but I'm being told it can come up very quickly in the next Congress as again, trying to show America that members of Congress can actually get something done. So Let's go on. What would it have? It would require every 401k, 403b, and simple plan to automatically enroll participants. The initial enrollment amount would be at least 3%, could be as high as 10%. You auto escalate 1% each year. And if you have sponsored a 401k, 403b, or simple plan within 1 year of enactment, your grandfather. So you don't have to add automatic enrollment. The plans, this mandate would not apply to small businesses, fewer than 10, new businesses less than 3 years old, or church or government employers. The Secure Act gave us a pretty substantial increase in the new plan startup credit for small employers. The current limit is, or the current amount is 50% of the administrative cost up to an annual cap of $5,000, assuming you have at least 20 non-highly compensated employees. It's $250 per NHCE up to 20. What the proposal would do is for employers, the small business generally is defined as 100 or less. The bill would provide that 100% of the new plan startup expenses would be eligible for the credit up to $5,000 if you have no more than 50 employees. Additionally, there would be a new credit that would essentially help fund contributions made for your employees in this new plan, and other than a defined benefit plan. And the credit would be a percentage of the contributions you made for them up to $1,000, and it would begin at 100% for the first 2 years of the plan, go down to 75% in the third, 50 in the fourth, 25 in the fifth, and no credit thereafter. So for the first 5 years of a new plan, the the contributions made on behalf of employees is essentially subsidized. If you're an employer with between 51 and 100, this credit is still available, but the applicable percentages are phased pro rata as you go from 50 to 100. So that's good. That's going to cost a lot of money. The bill also would correct the mistake, if you will, made with regard to the new plan startup credit under Secure. The credit is only applicable for the first 3 years of a plan, and therefore the pooled employer plans that an employer may join as a vehicle for establishing a new plan would not be eligible for the credit after the pooled employer plan's been around for 3 years. Now, it's possible the IRS may give us guidance to say, no, it does still apply. They gave us some guidance in Notice 20-68 that dealing with the ACA credit that said that. I'm not sure if they're going to feel constrained by statutory language or not. NOVA, we wrote a comment letter to the IRS on the notice and recommended to them that they clarify that it does apply. So we haven't heard back from them yet. I don't know why. What else? RMDs, required minimum distributions. If you have less than $100,000 in all retirement plans, then you can either suspend or will not have to begin taking RMDs till you go above 100K. And so it's not just the plan you're in, but it includes IRAs you may have and the like. So there's no way the plan sponsor will necessarily know whether the participant does or does not have other money in other savings retirement vehicles. And so the bill allows for the plan administrator to rely on the certification by the employee that they don't have any other assets or any other retirement savings that would put them above 100,000. What else on RMDs? The bill would increase the required beginning date from age 72, which was added by Secure, to age 75 for individuals born after December 31st, 1948. That will cost billions with a B of dollars in foregone tax revenue by allowing people to wait until age 75. There's a similar bill, bipartisan bill in the Senate, the Portman-Cardin bill, that does the same thing, but they use a budgeting gimmick and don't make that change until 9 years after the date of enactment. Why do they do that? Because that reduces greatly the calculation of how much foregone tax revenue such a change would cause, because they only look in the 10-year window from the date of enactment. That's possible. That's where this could end up. For the time being, it's effective at the same time as the 2021 plan year is what it's written into the law right now, into the bill, the proposal. That will likely, all these effective dates are sure to change when the bill is reintroduced in the new Congress. What else? Right now, C Corporation owners can sell their stock to an ESOP and take the proceeds and roll it over into qualified replacement policy, basically marketable securities. And by doing so, they defer recognition of the capital gain on their stock. The proposal would allow Subchapter S shareholders to receive the same treatment under Internal Revenue Code Section 1042. That'd be a nice little change. Another headache from Secure. The Secure Act has mandated that all 401k plans cover so-called long-term part-time employees, which under the Secure Act is defined as an employee who has completed three consecutive 12-month periods with at least 500 hours of services credited in each of those 3 periods. The purpose of this change was to give part-time workers the ability to participate and save in their retirement plan. There's no required employer contributions, and the Secure Act change takes effect on January 1, 2021. However, for purposes of eligibility, you don't have to count service in periods beginning before January 1, 2021. So under this 3-year rule, assuming you don't count service for eligibility before 2021, you would envision these part-time employees first coming into the plan on January 1st, 2024. The Secure 2.0 would reduce the 3 consecutive 12-month periods to 2. And its effective date is, as I put on the screen, it's effective as if it was included in Section 112 of the Secure Act, in the Secure Act. So it's retroactively effective, if you will. That's problematic. But again, this is coming from a bipartisan bill, as was Secure. What else does it do? Student loan repayments. There have been some 401k plans that have been making what are called matching contributions, but are tested like non-elective profit-sharing contributions for those fairness, non-discrimination tests. The the act would, or the proposal rather, would allow for true matching contributions to be made with respect to student loan repayments. As a result, the matching amount would go in to the actual contribution percentage test for matching contributions under Code Section 401M. The student loan repayment, however, is not an elective deferral. It doesn't go into your average deferral percentage test. It can be treated as a contribution that is matched for purposes of a simple or safe harbor 401k plan. Contributions have to be made available, these contributions, to all employees, and must be the same for both student loans and salary reduction contributions. Excuse me. Electronic communication. We were all very excited when the DOL finalized rules allowing for the electronic communication of ERISA notices as the default method. People can always elect paper, can elect out of electronic entirely if they want. Nevertheless, those regulations have been criticized by many. One of the sharpest critics has been the AARP, who feels that seniors and people living in rural America may not be able to access the internet or know how to do it. And so this bill would require at least once each calendar year you send out a quarterly benefit statement that is delivered on paper. That's for DC plans. For DB plans, it's at least once every 3 years. This seems kind of silly. Nevertheless, it's likely, something that may go through, but it probably will. I know some of the talk right now is rather than just sticking it on a benefit statement, just have a once-a-year notice type thing. And like the initial notice that goes out when you want to begin using electronic communication. I'm not going to go into great detail here, but the belief is military spouses move around a lot as their spouse is restationed at different places. The bill would encourage employers to hire military spouses right away so that they can be eligible to get a tax credit. The tax credit would apply only if the spouses are eligible to participate within 2 months of being hired, and they must be 100% vested in the contributions that are made. I don't know how attractive this will be to folks, but it's a policy call. There's a lot in Secure 2.0 with regard to the IRS Employee Plans Compliance Resolution System, EPCRS. And this first provision is something I worked on when I was at ASPA and the American Retirement Association. And what it says is if you've got auto enrollment and you make a mistake, somebody doesn't get auto enrolled, and that you can correct that as long as you catch it within 9.5 months after the end of the plan year. Why 9.5 months? Because that ties in to the extended due date of your Form 5500, which is when these mistakes are most often found. And it was just that argument that we made, ASPA made to the IRS a few years ago that resulted in basically having the same correction option right now as part of EPCRS. However, that correction option is set to expire on December 31 of this year, and at this point, I haven't heard anything of it being extended. This would put into the tax code the actual requirement, and so the IRS would have no choice but to extend this treatment. And again, it makes a lot of sense. It's a good thing. Also on EPCRs, it would allow any so-called eligible inadvertent qualification failure to be self-corrected as long as the IRS hasn't come knocking on the door in some way. In effect, it would extend the self-correction period indefinitely, but it has some wording that it will not apply to any failures that are egregious, diverts plan assets, or relates to an abusive tax avoidance transaction. It would also direct the IRS to put out more safe harbor correction examples. It would direct the DOL to treat loan self-corrections as satisfying the voluntary fiduciary correction program. Right now, if you've got a fiduciary breach as part of your loan qualification defect, the only way the DOL will allow you to fix that is by going through the voluntary correction program, i.e. make a filing with the IRS, not self-correct. And so this would allow self-correction of loans that would be deemed to meet the VFCP as well. It would allow correction of IRA failures and would allow up to 180 days to correct a missed required minimum distribution. Directs IRS, DOL, and PBGC to get together within 18 months, hold hands, sing songs together, and find a way to simplify and standardize the various notices and reporting and disclosure requirements under ERISA. Okay, good luck. I hope, anytime it goes to a commission, it's hard to imagine how much is really going to come of it, but can't hurt. For participants who have zero account balances and are not otherwise participating in the plan, you would no longer be required to send out ERISA notices to, as well as notices under the Internal Revenue Code. There would be a requirement to send one annual notice reminding them they can participate in the plan, but all the other notices would no longer be required. Moving on. The bill this is very weedy. Right now, under the required minimum distribution regulations, if you take an annuity as your form of distribution, it satisfies the requirements for RMDs unless the annuity has increasing benefits at a later date. And there's some rules about how you calculate it. It would also then, there are now annuity features that are popular and many believe would make annuities more popular that would violate this regulation, such as return of premium death benefit, guaranteed annual increase, even if it's in excess of inflation. The bill would allow for that kind of thing, direct the IRS to permit it, and it would allow for change the so-called qualifying longevity annuity contract rules to increase the amount you can use in your account to buy it from $125,000 to $200,000 and eliminate the 25% maximum limit, 25% of your account maximum as well. Overpayments. Mistakes happen. Sometimes retirement plans make payments to people they weren't entitled to. There's been some controversy as to how do you fix that mistake. And the EPCRs rules seem to imply that you needed to get the money back. In 2015, the IRS clarified that this recoupment, get the money back, is not always required. But many plans still do because of fiduciary concerns, as well as if you don't get the money back, then the employer's got to put it in. And so many plans still try and get the money back if they find out they paid somebody the wrong amount. And this could go on in a defined benefit plan for years and years. And there have been some egregious recoupment efforts where people, have a small annuity that were paid over a course of 20 years, an extra $30,000, and they say, well, we're just going to withhold payments until we meet the $30,000. So what this bill does is, one, it makes it clear you don't have to seek recoupment. Two, in considering recoupment, you can consider the potential hardship it would cause to the participant. And if you seek recoupment, you've got to do it basically within 3 years. And so it's kind of a recoupment bill of rights, if you will. Benefit statements. So this is a cure, I think, looking for a problem. Benefit statements you need for directed investment alternatives, designated investment alternatives, rather, you need to provide a benchmark so that can compare the return of the designated investment alternative to an appropriate broad-based securities market index. Well, that doesn't work for target funds because target funds are a mix of asset classes. The bill would direct, and DOL has had comment on that and never done anything about it. We've been dealing with benefit statements, for 10 years now. So I think we found a way to deal with it. But anyhow, this would correct this long time problem. That's not really a problem by directing the DOL to allow a blended asset benchmark, if you will. The bill would establish the so-called Office of Lost and Found, Retirement Savings Lost and Found, administered by PBGC. And essentially, you as a plan sponsor would you have to fill out the Form 8955 SSA, which gives the government the information on where on employees who have terminated and still have money behind. Essentially, this form would be made more robust so that information on the plan and the plan number could be folded into a searchable database so that it would be one stop for any plan you ever had to find out if you've lost some money. And I don't think anybody would criticize that. 457B plans, governmental 457 plans. Now you've got to, if you want to change your deferral rate, you got to do it before the beginning of the month. This would go to the 401k rule. You got to do it before the deferral, before the compensation would have otherwise been paid. Charitable contributions, the so-called qualified charitable distributions right now can be made from your IRA up to 100K. It doesn't go into your income, but does count toward meeting your RMD. The bill would allow qualified charitable distributions to be made from a qualified plan. And it would also increase the limit from 100K to 130K, and it's got a provision dealing with a once-in-a-lifetime gift to a charitable gift, remainder trust, or the like. Well, that was a lot of stuff there, right? And it's a very comprehensive bill. It's said to be, as it is written, it's effective for plan years beginning after 2021 or 2022. The deadline for conforming amendments is 2022, unless it's a collectively bargained plan. Again, I think most likely this bill will be back next year. I'm being told it may be, high on the agenda, and Richie Neal wants to do this. Kevin Brady wants to do this. Those are the two highest ranking leaders in tax in the House of Representatives, and Portman and Cardin are likewise, have a very similar bill. So one would expect that what we'll see is some merger, if you will, of the provisions in Portman-Cardin with what is in Secure 2.0. And as I say, 14 provisions in Secure 2.0 are the same as in Portman-Cardin. So it will make for a lot of, there will be a lot of interest come the new Congress. Let me quickly move ahead. Speaking of Richie Neal, I mentioned the Auto Retirement Plan Act. He introduced this in the last Congress. He was expected to introduce it in this Congress, but with the pandemic and everything else, and wanting to put the focus on Secure, it has not been reintroduced. But I do know that they are still working on it. And even if it isn't introduced in this Congress, it's sure to be back in the 117th Congress. And what it does is it requires everybody to sponsor either a 401k, 403b, or a grandfathered plan. This would be, for the first time, a mandate to American employers that you must have a qualified retirement plan of some sort. So it's either going to be 401k, 403b, or a grandfather plan is basically any type of qualified plan. It doesn't necessarily have to be a 401k. Also accepted from this mandate are small employers with fewer than 10 employees, new employers with fewer than 3 years of being in existence, church and governmental entities. Anybody over 21 must be covered. New employees must enter by the beginning of the second calendar month after you're employed. So basically anywhere from a month to 2 months, you'll be in the plan. A month and a day to a month and 30 days, if you will. Who doesn't have to be covered? Employees covered by a collective bargaining agreement, non-resident aliens with no U.S. source income, seasonal employees, which are defined as those not expected to work more than 3 months within the 12-month period beginning when they would have otherwise entered the plan. Grandfathered plans are grandfathered, but they are required to meet these new coverage rules beginning with the 6th plan year after the date of enactment, or the 8th plan year if the plan covers fewer than 100 employees. This is my favorite part of this bill. Under the bill, this is literally what the statute says. Under the fee requirements of this paragraph, no participant may be charged unreasonable fees solely on the basis that the participant's balance in an automatic contribution plan is small, or solely on the basis that adoption of such a plan by the employers, that should be employers, employees, by the employee's employer is mandatory. No, that's right. In any case, what I love about this, you can't charge unreasonable fees solely on that basis, but if you've got some other reasons, then that's okay. No, it's not okay. It's just silly drafting. It adds a new deferral-only type of arrangement. It's basically a 401k plan with no employer contributions, no testing, an $8,000 elected deferral cap with a $1,000 catch-up. It's got to have auto-enrollment. There's no ADP test, but you've got to enroll at least at 6% going up to 10 and automatically re-enroll all employees after 3 years. And if you have a lifetime income, you must have a lifetime income distribution option for at least 50% of the vested account balance. Good luck with that. And the mandate is accomplished through an excise tax. An employer that is supposed to have one of these plans doesn't have one is going to be charged $10 per day per employee during the non-compliance period. Limited to 3 months, so it's $900 per employee, and the excise tax maximum is $500,000 per year. That's quite a lot. Doesn't apply. There are a number of exceptions. Basically, you can look at them. We'll see where that goes. That Neal bill, again, is probably a Democratic bill. Wall Street Tax Act is also a Democratic bill. What it would do is add a tax equal to 10 basis points each time a stock is sold. and it would apply to retirement plans every time you put money in, you rebalance your portfolio, the mutual fund makes a trade. Prior versions of this bill had made an exception to the tax for retirement plans. This bill doesn't. It would greatly increase expense ratios, and so ARA is not happy with this. It is, again, a Democratic probably priority, and so it's probably not likely to go forward if Republicans hold the Senate. My clock says exactly 1 o'clock or noon Central Time. You can do the rest. So we are exactly on time. If you have any questions and you want to reach me, you can. My email address is choffman@nova401k.com. Hope you enjoyed the show, folks. I'm not sure. Do we have anything else closing, Jasmine?
Yes. Hi, Craig. Just some closing remarks. If you did submit a question, since we did run out of time, we will be reaching out to you directly with a response via email. And thank you to everybody for joining us today to talk about the Washington update and what it means for retirement policy. Please note there will be a survey that will pop up at the end of the webinar for you to complete if you need CFP, ASPA, or IRPA CE, so be on the lookout for that. These certificates will be sent out in 1 week, and the recording of this webinar will be available on our NOVA YouTube channel by the end of next week. If you have any questions that come up after this, please reach out to your account manager and they will be happy to assist you. And for any other questions, please email us at webinars@nova401k.com. Otherwise, everybody have a terrific Tuesday. Thanks, Craig.
Thanks, everybody.